Hey, good morning, everyone. Marty Missouri here, June 20th, 2022. Folks, today I'm going to do a few things. May take a little bit to do it. I promise I won't be too long and ramble off into too many side subjects. But what I want to do is I want to first update the technical charts, and we'll keep that one quick. We'll just do the 60-minute S&P 500 chart and then the one-year daily chart. Last time we did this was early Friday morning, so we had a whole day Friday. More developments on the charts that I just want to kind of share with you, or a continuation of a trend that I'm seeing on the short-term chart. Then I want to jump over to the somewhat lengthy log entry that I finished yesterday in our internal market log. Often I'll share those with you at the beginning of the week, like in the Monday morning note. But this one's too long to do that with. So I thought what I'd do is paraphrase what I wrote into our log and interpret some of that for you. As you may have noticed, those of you who read the blog regularly, the 3,500 target that we've established really from our work on the weekly and monthly charts, and then the assessment of overall conditions that we currently have that do not point to immediate recession or very near-term recession. However, the setup is deteriorating, and I could see us joining that camp if things continue to deteriorate as they have been. It is somewhat reminiscent of the 2011 scenario where our index got down close to zero but didn't quite get there, and that was during the European debt crisis, and a few other instances where we got low but we didn't quite go into negative territory. And sure enough, the economy actually came and rebounded out of that. So we had these, these mid-cycle slowdowns. And that's right now still our base case. And if that's the case, then, our 3,500 target looks pretty good to us. So if we were to, over the near term, really drop down into that level rather quickly, let's say we continue with last week's downward momentum, we would get there conceivably this coming week. We would stay hedged, but we would begin to do some rotation and deploy some capital into some of the areas that we want to either own more of, that we're very bullish on long term, or some of those really beaten up areas that we think provide good long-term value. But then we'd continue to be very cautious and try to protect a further washout to the downside if indeed we do roll into recession, as many people are calling right here. So I'll get more into that. I'll get more into perspective on the Fed and some of the signals we're seeing there. Because right now, as you'll see, and I'm going to just kind of get ahead of myself, but I'll get to that when I paraphrase the entry to the log. Seeing, a really strong setup for what still could be a pretty good bear market rally. And I'm also seeing it in the technicals right here. And the fact that fewer and fewer people are calling for that and calling for just more of a washout to the downside actually kind of emboldens that view a little bit. And we'll kind of get into that as well. So on this 60-minute chart, folks, what you can see are patterns that have been pretty telling if you've been with me for the last few months anyway on the blog. And that is, in my view, we have a clear falling wedge here, and in this one just kind of got extended, right? We had it here with, we had a bullish divergence here on the MACD, as you can see, and let me bring in the RSI with that so you can see that as well. And so you had those bullish divergences, and you got a little bit of a pop, and that was quickly given back. So you'd call that a failed breakout. Nothing like this one. Remember, we saw lots of potential coiled spring action in here that really played out nicely, but I actually was a little too ambitious with my upside target. I was thinking we'd get there. And again, we still very well could before we ultimately get to levels that we're comfortable with, taking long-term positions in this market, or new long-term positions, I should say. So here we have it, very much continuing with pretty good, solid, bullish divergences in these two momentum indicators. Now, if you're a short-term trader and you want to be smart and do this right, you would wait for a good breakout with momentum above this line before you go in and try to game a swing trade, maybe, come up and fall against these different levels. Volatility is where traders really do well, short-term traders, if they're on the right side of the trade and if they're doing the right work. So there's nothing that looks too scary about this 60-minute chart, folks. The way we look at it, some would say, oh my gosh, lower lows and lower highs. I could just imagine the cringing and the criticism I would receive from some technicians who I'm aware of who would say, this is just a terrible looking chart. Look at the lower lows and lower highs. And I say, yeah, but we're talking about the prospects for a bottoming right here and a near-term rally amid arguably bear market conditions. And then on the 1-year daily chart, you're not as promising right now as I speak, and the cash market isn't trading, but futures are trading, and the Dow's up 200 points, or the S&P is up 82 bips. So we'd see a nice 30-point pop or so if that were today, right now above this. So you do have the bullish divergence here. You're about to lose it here. This needs to turn up, and right now the 60-minute chart says this is about to, and suddenly that's going to echo what we're seeing in the 60-minute chart. Then we've got these higher levels that we can talk about. Okay, so that's the technical look. Now if I go to the weekly and I go to the monthly, nothing encouraging there whatsoever. Still points to the lower level, which is 4 to 6%, depending on whether we're talking the weekly or the monthly chart from here before we get to that target that we've had for the current bear market. A target that, as I kind of alluded to lately, is getting a little bit weaker, or a line that's getting a bit thinner as macro conditions continue to evolve. Okay, so now I'm going to pull over my latest entry to our market log, or call it our market scripts. So last couple of weeks I've been talking about this unique setup overall in the world of options and options dealers and dealer hedging and so on. So we partner with, or we pay a firm that is just one of the absolute best, and all they do is decipher the options market, option setups, and so forth. A lot of great proprietary original work. So I can't really explain what this, I can explain it, but I'm not going to. This is a completely unique, original, proprietary index. So I just want to show you, if you'll allow me, what our friends here at this firm have recognized is these points on this particular indicator that they created, that we just got to here very recently with the current setup, ahead of last Friday, which was one of the biggest options expiration days in history. Certainly the biggest since right here in March of 2020, right before the market ramped up, in December of 18, right before the market ramped up, and back here in 2016 and 15 as well. I didn't circle these. But we got to levels that historically the last few years have led to major pops in the market. So what I was kind of anticipating is something special, as all the dealers who are very exposed to this, to puts, would have to cover the shorts that they used, the short positions, shorting the underlying, that they had to do to hedge their extreme downside risk. And some of that, I think, occurred last week. We had that big 600-point rally in the Dow. On Fed Day, ended up coming back to a 300-point gain. When I look at other indicators like futures positions on the S&P 500, they went from net short to net long last week. In our weekly flow, looking at SPY, the largest ETF, it has huge optionality, so a lot of that options exposure was happening on that ETF. Huge inflow last week, biggest in several years of money into that fund this last week. And when I look back and charted that tended to happen on those options expiration weeks. So a lot of that may have occurred and been absorbed already. And derivatives and second derivative readings of the S&P 500 are suggesting that that opportunity may have come and went without really the big bang that we've seen. But again, we could see quite the ramp up early this week, and it still could be some serious short covering that engenders that. But I'm not making a prediction. I'm just talking about possibilities, maybe not even probabilities right here. And I do want to add to that narrative a little bit with the shorts. So according to this snip right here, hedge funds by and large, really ramped up their short positions. If you read from here, last week, when we observed that Monday, the S&P 500 finally tumbled into a bear market, saw the 5th largest sell program in history, which was promptly surpassed by even more furious selling on Thursday, when the high-low tick indicator hit a negative 2,057, the 4th biggest selling program on record. And while there was some selling of existing positions, much of the action was putting on new shorts, with Goldman Prime saying that hedge fund shorts climbed aggressively, with broad-based investment strategies or macro products like exchange-traded funds dominating the flow. So, notwithstanding what I just said about futures traders' positions going long, and then that huge influx last week into SPY, apparently, according to these folks, there's just a monster amount of short positions that were taken last week. Now, short positions are stocks that need to be bought, right? So if we do see suddenly a surprise ramp higher, well, then you're going to see a lot of short covering, and that could exacerbate something serious to the upside. So again, folks, that would be reason to think that maybe there's, a good bear market rally in the offing. Other short-term potential bear market catalysts. So there's some serious rumblings. Bear market rally catalysts. There's some serious rumblings of a U.S. fiscal spending deal being announced next week, although it'll be represented as an inflation fighter, which is utterly counterintuitive to me, so we'll see. And I thought about getting into those weeds. I read a lot about it. We'll just leave that one there. But, the market likes fiscal juice, so we'll see. China. U.S. Treasury Secretary Yellen said some of the tariffs have no strategic purpose. Beijing reopened metro stations that were closed due to COVID. Now, folks, you've gotten a hint. I'm pretty bullish on Chinese equities because of the political risk of Xi continuing with these zero COVID lockdowns and the rumblings about stimulus to come, and clearly the flip, not a 180 flip, but the noticeable move back to being somewhat lenient with the tech companies and the gaming companies and Alibaba that they have been really cracking down on the last year or two. So the Russia-Ukraine situation, this is over the weekend. Putin, we are ready to restore our relations with everyone after the military intervention in Ukraine. Putin, restoration of relations with Ukraine is inevitable, right? So that's, quite the departure from what we've seen, even some of the military action over the weekend and so forth. So I'm just throwing that out there because I'm beginning to see more and more rumblings of something that could ultimately become a ceasing of military operations, right? And of course, that would be huge, at least short term, for markets. Additional near-term developments, ones that may inspire dovish, or let's just say less hawkish, Fed speak, and could therefore be net near-term bullish. Make no mistake, folks, any hint that inflation is coming down off the boil and that the Fed may not have to be as aggressive as they've threatened to be, the market's going to like it, at least on a short-term basis. Okay, so this week's drop in oil prices, last week's actually, weakening manufacturing data, a nascent rising trend in weekly jobless claims, falling housing starts and permits, rising credit market stress, all reflected in market-based expectations coming off the boil. I think I showed you this in the macro index, inflation swaps rolling over a bit, 2, 5, and 10-year. The 10-year high yield spread, right? The difference between the yield on 10-year junk bonds and the 10-year treasury has been ramping up quite noticeably. So folks, that suggests the kind of potential weakness in the economy that raises default risk on junk bonds. Of course, higher interest rates would do that as well. And this is something that the Fed, I think, really frets over. You saw them jump in to the market here and do something that, in our view, that was patently illegal. The Federal Reserve Act says they can't engage in corporate securities. And that's exactly what they did to rescue the world from this, so to speak. And so you can see that this is getting to levels that I am certain right now has the Fed's attention, And then credit default swap spreads, so CDS, essentially the insurance against default in corporate debt, in this case 5-year investment grade corporate debt, has really ramped up significantly. So this suggests that default risk is on the rise, at least reflected in CDS spreads. And again, these are things that the Fed would lose sleep over. It would be a big credit crisis a la 2008, and what ultimately, in our view, was going to happen during the next recession that got rescued by the whole COVID scenario. So this is the sort of thing that is going to have the Fed's attention as they continue to tighten, no doubt about it. And then Fed speak headlines over the weekend. Loretta Mester, Fed member, recession risks are increasing. I do want to see slowdown in demand. Despite slowing growth, I do not expect a recession. They're always going to say that. ECB is out there saying that today. Some inflation indicators appear worse in May than in April. So that would be something that would justify the tightening that they're doing. It will take time to get inflation back to our 2% target. Waller, who has been pretty hawkish in his tone of late, even in a typical recession, there is good chance that the Fed would need to reduce policy rate back to zero and purchase bonds once again. So the Fed fully expects to be back at it if we were to dip into recession. The gradual approach to tightening following the Great Recession influenced the approach this time, for what that's worth. Future forward guidance on the time frame of interest rates from zero levels should include rate rise path guidance. I will support a 75 basis point interest rate hike in the June policy meeting if data come in as I expect. So if data does not come in as they expect, as things begin to deteriorate like I've shown you some, then the 75 basis point interest rate hike is going to be off the table. Widespread fear of recession is a little overdone. Excess labor demand raises wages. It's difficult to express how tight the labor market is right now, although anecdotally we're seeing lots of signs of layoffs really beginning to pick up. Unemployment may have to rise to 4% to 4.5%, could become worse. Okay. I just want to slow down the economy. I do not want to cause a recession. Again, folks, so I do believe that the Fed cares. A lot of pundits have been saying, no, the Fed is looking to cause a recession because the only way they're going to get ahead of this inflation. Well, if inflation moderates, right, I think it's either peaked or it's soon to peak. Clients, again, as you know, we're structurally bullish, meaning we think inflation is going to be higher for a lot longer. But we do think that it's going to plateau and come down slowly. What I'm saying is, though, this popular notion that the Fed is after a recession, a la Paul Volcker, I don't think so, because the recession creates that nightmarish potential in the credit market. It's unclear if inflation is going to go away next month or the month after. The bind we found ourselves in, a CPI report that did not match the forecast at all. When forward guidance falls short of expectations, you must make a decision. We're at the point where we need to move rates a lot to get to neutral, then restrictive. Markets would have a heart attack if the Fed did 100 basis point hikes. Still thinking about markets. Waller backs another big hike for the all-in inflation fight, wants another 75 basis point hike in July, but also concerned about recession, and obviously is willing to back off quickly if indeed the data suggests that he should. And we're seeing some of that. And again, this doesn't make us structural bulls on stocks right here. We still think the bear market has more downside to explore, but I'm seeing some real signs that there may be a significant bear market rally in the meantime. Then there are the sentiment dynamics. Per the below, the bull-bear spread among advisors is at an extreme and at a level typically that closely precedes strong equity market rallies. So I've been subscribing to this data for years, folks, and it is amazing how telling or how predictive it can be. So the bull-bear spread this last week is 13.3%, meaning there's a net bearish sentiment among investment advisors, newsletter writers, and so forth. So 13.3% is the spread in the negative. Minus 4.3 last week. The difference has been negative, more bears than bulls for 11 of the past 15 weeks, and one of them was even. Our data shows 17 weeks with more bulls than bears to end 2008, and 11 weeks that led up to the 2009 bottom, okay, which was an epic bottom in stocks. Largely negative differences signal diminished risk and allow for accumulation. And the opposite action, of course, on the bull-bear spread. And I remember, folks, I did a lot of videos showing this very short-term chart that they do of the danger for the market when we got up that high before. This has been a rare occurrence, this low, since that 2009. Negative spreads point to lowered risk for longs the larger they get. Similar buying chances were minus 4.7 December 2018. That's where that options dynamic also pointed to a big rally, and the bull-bear spread was minus 4.7 right before stocks began to ramp up. The end of that correction in February 2015-16 was at 14.5, so not far off of where we are. And that late October reading was minus 25%. So, folks, as you can see, we are at historic lows right here, at areas that tend to precede big ramp ups in stocks. And I think this time all we may get is a pretty substantial bear market rally, but they do come, and they can be substantial, and they can go for months, as I've illustrated for you before. So then the individual investor, they essentially tell the same story. Historically, the S&P 500 index has gone on to realize above average and above median returns over 6 and 12-month periods following unusually low readings for bullish sentiment and high readings for bearish sentiment. So here's that spread as of this last week. 19.4% bullish against 58.3% bearish. Okay, so that is quite the net bearish spread, and typically that precedes a nice upturn. Again, that's everybody on one side of the boat, everybody bearish. You get a little good news. It's kind of like being short. The market ramps up, and suddenly, bears come off the sidelines because they think the worst is over. Shorts have to get covered, and you have kind of this perfect storm that could give you a pretty good bear market rally. So here's one of our own. This is the percentage of S&P 500 members trading above their 200-day moving average. It is exceedingly low here currently, and I drew this line right here, folks, and all these little yellow X's. These were double-digit moves in 2008. These were like huge moves in the market that lasted for several months. I know it doesn't really scale very well right in here. This one right here, of course, was the beginning of the end of the bear market. Here's 2010. We had a double-digit correction that got us to these levels, and boom. The 2011 European debt crisis, This got in here, bottomed, and worked its way higher. The 2015, we had a nice rally, got back to almost to the previous high, and then rolled over again in 2016. Both times, these levels preceded big rallies. The nearly bear market in fourth quarter 2018, got to this low, then we rallied, COVID, and here we are currently. So, folks, again, there's no assurances here, but this is another counterintuitive kind of breath reading. It says, oh my God, all hell is breaking loose. Yeah, but typically it's such an oversold level that you get bounces off of it. 50-day moving average, of course, noisier, but same kind of look. These levels preceded some pretty good pops in the market. So as I continue to go through all of our stuff, there's actually more than this. There's still all the bearish stuff, the weakening macro and everything else, but call it technically or internally, there's these kinds of data points that have us thinking that the market could ramp up pretty nicely. Lastly, the NASDAQ composite has, for the second time in the past 4 weeks, just moved back into rare oversold territory. Now, I did spend some time on this on the blog already, and I showed you back, oh gosh, I think it was 30 years or so. Yeah, it was, because I put that chart here. Anytime during these rare occurrences, these are the circles down here, that the NASDAQ composite got into oversold territory in the RSI, which is below 30, and it was 29 on Friday. You got big rallies. Now, up until the rally that this one preceded, the lowest return in the ensuing rally was 14%. This one made it to just about 12%. We'll round it up to 12%. So we're here again, on top of everything else, could see, a pretty nice pop. Now, all of the above said and illustrated, I'm still only talking about the potential catalysts for a decent bear market rally. The longer-term price charts, macro and earnings prospects, central bank's posture, credit market conditions, and so on present general conditions that ultimately overwhelm all of the above and therefore have probabilities pointing to yet lower lows before this is all said and done. And let me wrap it up with just my part of some correspondence with a client over the weekend. And he read where I said our 3,500 target is beginning to thin, and he wanted some more color on that. So here's what I said. With regard to the S&P 500 target, technically speaking, it's the area relative to price action and key moving averages where corrections and bear markets, outside of recession, mind you, the past 30 years have bottomed. Key words being, of course, outside of recession. Now, one might argue that the precedent the Fed and Washington set when the market collapsed in 2020, trillions of dollars, presents a case that if we dip into recession, they'll flood the system once again and once again rescue the markets. Well, perhaps, but presumably there'll be no pandemic lockdown to use it as an excuse. And the monster difference today is inflation. It's a huge factor that didn't exist then and arguably has been notably exacerbated by all of that stimulus. In a nutshell, if corporate earnings contract notably, as they do during recession, against the current backdrop, and there'll be no liquidity brought to bear the likes of which we saw in 2020, again, the likes of which we saw in 2020, and I'll say at least not initially, it would eventually come if we're looking at potentially a big credit market event. Highly likely that we're looking at much lower lows. The past two recessions saw 50% and 57% drawdowns respectively for the S&P 500. All that said, if we were at 3,500 today, we would scale in a bit of the cash we're sitting on, as I mentioned earlier, do some rotation, but we'd keep some powder dry, all things considered. So folks, I'm telling, two tales here, right? I'm talking about just a plethora of data that says this market is ripe for a potentially substantial rally, and I'm going to call it a bear market rally. But when we get into the weeds and we get deeper below the surface, we have this setup that I just illustrated for you. A little bit of contradiction here because I talk about the Fed not coming to the rescue, where I just showed you that credit stress is beginning to rise to the point where they may come to the rescue. What I'm saying here is not to the extent that they did in 2020. They had political cover because of COVID. That doesn't mean that precedent wasn't set to the point where it doesn't have to be COVID the next time to go that deep. Maybe they will. I'm just suggesting that the Fed put is still there, but it's lower than it was, say, a year ago or 2 years ago or at any time over the last few years, or that the risk that it's lower is certainly justifiable or certainly something to believe in, given what I shared with my friend in this email here. So folks, what does it all mean? It's just us looking at the setup, both short and long term, and really wanting our clients to understand what we're thinking and why, and all the empirical evidence and the data that's behind it. So as the market goes through the excessive, extreme volatility that it's going to go through, you have something that is thoughtful and empirical to think about if you want to think about these markets at all. So keep all this in mind. And of course, I will keep coming back with more commentary as things evolve with what our perspective is. And folks, I will leave it there. Thank you for staying with me this long on this one. And be back soon. Have a great day. Bye-bye.